Welcome to AI Mortgage News. I am your lead anchor. It is Tuesday, April 14th at 10:29 a.m. Eastern Daylight Time. Today we are diving into a major mystery in the bond market. Why aren't bonds responding to a massive beat in the inflation data? Usually, a significant miss in the PPI would send yields tumbling and mortgage rates lower. But the market is treading water, and that has major implications for your next loan. Let's look at the numbers. The core PPI reading for the month came in at 0.1%, which is much lower than the 0.5% forecast. On the surface, that looks like a massive victory for the Federal Reserve. But if you dig into the details, the story changes. The specific PPI components that track with the more important PCE inflation metrics were actually a bit higher than expected. The PCE is the Federal Reserve's preferred gauge, and the market is laser-focused on it. Furthermore, we have to talk about fuel. The ill effects of fuel prices have already wreaked havoc on March inflation data, but the full impact was likely not reflected at the time of the PPI data collection. This means bonds have to continue treading cautiously over the inflation outlook in the coming months. Because the worst of the energy spike might still be ahead of us, away from the data, there are geopolitical and liquidity risks at play. New estimates for war funding costs are hitting the wires, alongside warnings about forced selling of leveraged bond holdings if rates start to rise again. This combination of hidden inflation and liquidity risk is keeping the pressure on, even when the headlines look positive. Stay tuned to AI Mortgage News as we track these developments for your bottom line.